From the morning reading. Stocks rise on Tuesday. The Qs have a bull flag and the spider bounces. The cruise line sails higher. 7 of 10 sectors moved higher on Tuesday. XLK, XLY, and XLF were the strongest sectors, while XLU was the weakest sector. While futures fell 69 cents to close at 44.93 as no Saudi Arabia and an Iran production deal in sight. Breadth strengthened as advancers led compared to the prior session by 1787 to 1253 on the New York Stock Exchange and led 1859 to 962 on the NASDAQ. On the S&P 500 snapshot, a modest post-debate rally. Today, the popular press was in general agreement that Hillary bested the Don in last night's debate, which apparently was a relief for Janet Yellen, who, according to a CNBC article, would quickly tender her resignation if Trump should become the 45th president. In any case, today the benchmark S&P 500 gyrated at the open, showed indecision during the first 90 minutes of trading, and then rose to its 0.70% intraday high in the early afternoon. It then traded in a narrow range and closed with a slightly trimmed gain of 0.64%, reclaiming a bit over half of the pre-debate sell-off following last week's no-rate hike rally. The yield on the 10-year note closed at 1.56, down 3 basis points from the previous close. Also in the morning reading, consumer confidence is high, but expectations are low. According to the Conference Board, consumers are the most confident they've been since 2007, but despite the stock market being one of the most positive aspects of the economy, consumers' expectations for further gains are among the lowest ever when their confidence in other aspects of the economy have been so high. That has been an okay sign for stocks, but not as good as we might think. Traders are giving up on the dollar. Currency hedge ETFs have seen some of the biggest outflows among all funds in recent days, and funds that bet on a rising US dollar have seen their assets dwindle to the lowest in years. That usually means limited downside for the buck going forward. After bailing out of bonds near the lows, traders are piling back in. Some of the largest inflows among the funds were tracked in J&K and LQD. ETF traders have proved to be poor market timers in recent months, and heavy inflows as the funds plateau and big outflows as they're about to bottom. That's not a good sign for the funds in the short term now. Stocks reacted positively to yesterday's presidential debate. From the table, or the chart, the S&P rose the day after a presidential debate. It showed a positive return through the election 11 out of 15 times, averaging 1.2%. The 4 losses were on the smaller side at 0.1%, 0.2%, 1.6%, and 1.8%. Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:29 a.m. Mountain Time, and I'm recording this in preparation for the market day, September the 28th, 2016. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. Okay, let's go ahead and dive into the morning report. And at the time of the cut, the data was a bit mixed, but all rotating around scratch. In fact, none of the 4 U.S. broad market indices have separated from scratch by any significant amount. Crude oil is up about 1%. Euro is at scratch. Bonds are at scratch, as are gold. In overseas action, this is 928 on China. You do have China down about 1/3%. Hong Kong up about 0.2%. Japan down about 1.3%. And Germany up a little over 1%. United Kingdom up just under 1%. And macroeconomic reports of note for today in the United States, you have core durable goods, Fed Chair Yellen speaking, FOMC member Bullard speaking, and ECB President Draghi speaking. That's listed under Europe, but that one could be a market mover here as well. Crude oil inventories also come out today on their normal time. And then FOMC member George speaks late this evening. And in terms of looking forward to tomorrow, items of significance in the U.S., final GDP, weekly unemployment claims, FOMC member Powell speaking, pending home sales, nat gas storage, Fed Chair Yellen speaking once again. So pretty big slate here in the next day or two. Keep that in mind. In terms of current volatility conditions, things settled a little bit yesterday. Short-term VIX dropped to a 12.80. Skew is benign. IV percentiles, while elevated compared to where they were a couple weeks ago, dropped quite a bit from where they were the session prior, with the S&P at a 20, the Russell at a 12, the NASDAQ at a 16, and the Dow at a 21. We did have positive standard deviation moves put in by both the Russell and the Dow yesterday. I say that. Actually, it wasn't the Russell. Sorry, I misspoke. It was the NASDAQ and the Dow that had positive 1 standard deviation moves put in yesterday. Let's go ahead and go to the charts and see if there's anything of note here. Let's reposition that just a teeny bit. So on the S&P futures, you see we've been playing with this big kind of consolidation pattern, a little bit of a break on the 9th and then into another consolidation pattern, which is now into the cloud and not really showing much inclination to go up or down. And we've been talking about range-bound activity for so long, it seems almost trite now to say the word range, but that's what we are until proven otherwise. We certainly have significant overhead resistance, and you see this area around 2190. Basically, we would call anything less than 2200 the area of resistance, and we would want to see a clear breakout with a confirmed close above 2200 to think that we are doing something of significance to the bullish side. And then on the bearish side, you see we come down here where we play around the 2100 area, and we've talked about this range, this 100-point range, for several weeks now. We've been bouncing around the top of the prior zone of resistance, now turns support, and that indeed has acted as support. But you know, within this area, we're just bouncing back and forth. We had a little increase in volatility, yes, but that's now starting to subside. First debate is past us, though there are a number of things coming up, Italian votes, and other things. The Deutsche Bank situation is continuing to deteriorate. And keep an eye on that. That is a very, very important marker for the European economy in general and the German economy especially. There was a comment posted about that Merkel, the leader of Germany, had said that the German government would not bail out Deutsche Bank, but we'll see where that actually goes should that become necessary. If you see Deutsche Bank drop below $10 a share, that would become an area in which momentum might increase and serious consequences for Deutsche Bank might start to become more relevant with each passing day. That bank is down some 60% in value from its high not that long ago. Okay, let's go ahead and go to the Dow, and I don't think we're going to see anything different here. Also in the cloud, also in the same sideways consolidation pattern. Now the Russell and the NASDAQ have been a little different of lately. They've actually been leaders. We've got a bit of a double top here on the Russell, though certainly in relative proportions, you know, we're up above the cloud here. This is frankly looking more like bull flags. You know, you did have the pullback, but then, you know, everything's been strong since, and ran up against resistance, pulled back, but looks to be setting up for a potential bull flag and make another run at that. And I'd be surprised if it didn't get through on the third time. So definitely more bullish on the Russell. And then NASDAQ, of course, just a few sessions ago, put in a new 52-week high and has fired a new bull flag entry with recent action. So also above the cloud, also much like the Russell, bullish and even more bullish, frankly, than the Russell. Now, much of this has been on the backs of Amazon and others. You see yesterday, Amazon did have a new 52-week high. This has been a pattern here. When the rest of the markets pulled back, Amazon's continued to power up. You see, on the 9th, yes, it was a down day for Amazon, but, within a week, it was right back and obliterated. And now, within a few more sessions, rose to all-time highs. So very, very strong relative strength coming from Amazon. One of the other places you might look to play this, FDN. This is the Internet ETF. And obviously, players such as Amazon are going to be a big part of this. If you find that buying Amazon and Google are too expensive for you, this might be a way to get exposure to some of those names. And you can look up, who's the primary composition. Do be aware that a handful of those big giant companies are dominating to this ETF's composition. So you are playing the Facebooks, the Googles, the Amazons very heavily, I would imagine, if you're buying into FDN. I haven't looked up that composition recently, but I would expect that it would be very, very heavy in those names. And let's see here. Let's go ahead and take a look at their other markets. Crude oil continues to be the picture of sideways consolidation action. Very neutral here. Gold. At one of these points, I'm going to expect that gold is going to break up through what looks to be a bit of a coiling or ascending triangle formation. But that being said, it could take a while. And if you note, if this is indeed an ascending triangle, we've got a long way to go to the apex. So while it doesn't have to wait till you get towards the apex to break out of an ascending triangle, it could stay in this consolidation pattern for quite some time. You notice the prior times that we've done this year, this one right here, we had weeks spent, really about 2 months in this pattern before it broke out, just to shake everybody off, undercut the prior level of support, and then go running back up, and then into this new consolidation pattern. So stay very, very calm with your gold trades. Got to be very patient, but that continues to look, by and large, bullish. Of course, much of this is a relationship with the dollar, and the dollar is also in a neutral sideways consolidation pattern. So very hard to see anything coming out of any of these markets right now in terms of any kind of trending action. And then we'll take a look at bonds. Bonds certainly have reversed off those lows, but still are in a bearish posture down below the cloud. Many of those moving average lines up above. Lots of overhead resistance. So hard to see bonds doing anything big to the upside unless the overall market starts to trend, and in this case probably trend downwards. Yesterday you had kind of the unusual situation where bonds were up over I think it was up over a standard deviation much of the day, and then also the broad market was up much of the day. So both bonds and equities up. So that's not the typical correlation, but certainly can be on any one trading session. Quick look at volatility, and you see volatility's been falling. And right now we seem to be, back under 13 as it were, or right around 13, and very, very benign as it would stand right now. Not actually in a VIX daily squeeze, but certainly could be setting up to begin another daily squeeze on volatility. Okay, that's probably enough on the charts. Let's go ahead and go to the regular daily report. Some changes here today. We have, with this market trend intermediate term phase opinion, I took a closer look at that after the video yesterday and determined that we were indeed probably market phase 4, which is up against various resistance patterns, whether it be horizontal or whatever. It's up against resistance, and until we break through those resistance areas, we seem to be, in that kind of phase opinion. On our 3 market timing mechanical signals, the first one from IBD, that is in confirmed uptrend. The second one improved pretty significantly yesterday. GMI index went to a 5 out of 6 and a 7 out of 8 on their 2 indexes. That buy signal's been in place since 9/22, so that's bullish. And the stock charts decision point scoreboard, we did have one area of improvement. The short term on the NASDAQ is now uniformly bullish, and you note that short term, intermediate term, and then just the long term is giving mixed signals. So the NASDAQ's definitely the leader of this group, and you see that the S&P, both the 100 and the 500, are neutral to bearish on the short term. Dow also neutral to bearish on the short term, as it is on the intermediate term, and then mixed signals on the long term. The others have generally positive, bullish on the intermediate term, and then those mixed signals coming back in the long term. So this is a very, very, very choppy kind of mechanical signal. And as a result of that, we would expect that our overall bias, when mixed with the other mechanical signals, would be that we would have a generally bullish bias, and yet at the same time an expectation for a lot of chop and achieving anything. So kind of keep that in mind as you take new positions or close positions. You might want to, in this kind of environment, especially if you're swing trading, take smaller targets and maybe take 2/3 of your position out at your first target and hold just 1/3 of the position for the secondary target. Very hard to get much follow through when you get this kind of signals historically. In terms of position sizing opinions, both models, both the investor position sizing opinion and the volatility for the active trader position sizing opinion, are both at 100%. Intermediate term market posture, some improvement here yesterday on a number of these, especially NASDAQ and Russell are very nicely strong bulls. NASDAQ even more so. S&P improved a bit and now is at 57.7. So intermediate term market postures in the primary markets are strong. Now the Dow still is weaker and has been in a strong bear intermediate term market posture for recent sessions. That one's a little bit out of kilter with the others, and I would frankly expect that it would turn if we continue to get leadership and strength from the NASDAQ especially. Hedge warning status, we've remained at 0+ through the recent weakness. I took a close look at that during the days I was on vacation and where the mechanical signals would have had us. I suppose if I'd been here every single day, there's a chance I might have gone to a level 1. The market timing signals certainly during that time did go to uptrend under pressure for a number of trading sessions, but never really went anywhere after one big down day, and then after that stabilized right away. So I'm gonna just basically call this 0+, normal with some cautionary aspects, both in recent trading sessions as well as our current opinion, which is frankly the most important. Option income strategies, the VIX is in the acceptable window to initiate new positions for novice traders. Just kind of keep in mind that you do have this bit of choppiness, so this could go both ways when you have this kind of choppiness. But from an option income standpoint, everything looks to be, frankly, in pretty acceptable conditions to initiate positions. Cover call strategies and put selling are also acceptable to initiate new positions for novice traders, though a bit more defensive than we've been of late, with a 2-to-1 ratio of in the money, out of the money strikes. Both same ratio for in the money, out of the money strikes, as well as the ratio of low beta versus high beta positions, being relatively conservative here right now in this market situation, or our tone is one where we're not getting much follow through on bullish setups. Volatility base, you see, frankly, quite a bit of improvement yesterday. You had a number of these that were in warning status that have fallen off that warning status. And really the only thing to get excited about here is this S&P distribution day count is at a 7, which anything over 5 is warning, and this is certainly pretty high. We'd like to see some of this ebb off. The 10-day out expected move is actually below 40 now. I need to change that one. So that one should have gone to black. This one should be black as well. So really the only thing out of that, in an area where this was pretty red yesterday, much of it's resolved. Under trend base, everything's fine. Intermediate term market, I should say intermediate risk aversion indicators, still all marginally as risk off. These are downsloping lines with some minor separation, which gives us this risk off setting, but certainly none of these have got a significant separation in angle. Really, you could make an argument that this is neutral to slightly risk off. So that is one area of concern. In terms of sentiment, no excessive sentiment in any of these 4 markets at this point. And then also on the fear and greed index, it's fairly neutral. So nothing really to get excited about sentiment one side or the other. You see yesterday's action in terms of sector performance, pretty good performance really across the board in all the sectors, with the exception of energy was mixed. Real estate and utilities are uniformly down yesterday, with really only one large utility player being positive. So kind of keep that in mind. It would seem something of a kind of risk-on day where money was rotating out of these more defensive areas and to more higher beta areas, at least for yesterday. We'll watch and see how that continues to perform in ongoing sessions. In terms of market postures, you see this is pretty much a Christmas tree. A lot of choppiness going back and forth, and frankly a lot of these lines on these market postures are relatively neutral, so they quickly flip back and forth signals as they go positive or negative. Probably the most consistent are coming from technology. Technology has definitely been a hotter sector of late and more consistently positive, and you can see all 3 time frames are bullish there. Also, in general, transportation has been doing a little bit better of late, and then telecom and industrials also are positive, though not as dramatically as some of the others. And you see the breakdown by group yesterday. With utilities and real estate being the 2 negatives. Information technology, consumer discretionary, the biggest positives on the day. So definitely more of a move towards high beta, kind of risk-on areas of the market. Also, I didn't have time to really talk about this yesterday, but I will say for this week, right now, where are we seeing industry group or sector performance leadership? It is in these few names right here. And you can see where these are. This is the S&P Biotech, XBI, Semiconductors, XSD. We've been very much in favor of this FDN ETF. I mentioned that with the chart review a few moments ago. And then regional banking. So those 4 are definitely the sectors or industry groups that are up here in this area where we like to pay a lot of attention from our watch list. So kind of keep that in mind. That should be enough for today. We're a bit long, but obviously we're kind of getting back into the swing after the extended vacation. Let's go ahead and roll through to the disclaimers. Disclaimers, as always, hit the pause button if you need more time to review. And then also note the hyperlink down here at the bottom for the full set of disclosures. Watch those risk management parameters. You do that, everything should fall into place. And good trading to all of you from Falcon Global.